Welcome back. Still watching the newsroom. Sue is still with us. Sue, how are you analyzing the valuations of equities across the world, be it developed market equities or emerging market equities? After the sharp correction, have they entered attractive zone or not yet?
Again, it really depends on your investment horizon. I was saying before the break that there are signs that from a positioning perspective that we are much better balanced now, and that the risks are asymmetric to the top side in terms of the news flow. So the sell-off that we might get on bad news would be less than the rally that we might expect from good news. In the longer term, though, we do see that there is a risk of a bigger economic or credit event down the line. There are structural implications that extend far beyond 2020 from COVID-19 in terms of, continued deglobalization, the rise of modern monetary theory, persistently low interest rates. But from a tactical perspective, as I said, with the risk asymmetric to the top side, there are some potential opportunities to get long in the shorter term. But I still think that if you really want to immunize your portfolio, if you will, the main tenets remain, and that is that in credit and equities, you really must still be tilted to quality, strong balance sheets, cash flow, those with low debt. They remain the most attractive out there. In terms of the yield curve, we're looking for a modest bias towards steepening. That's a result of just the sheer amount of stimulus that is in the system. And in the foreign exchange markets, we remain biased towards a stronger US dollar over the longer term.
Right. How are you finally analyzing the kind of measures which regulators and central bankers across the world have actually taken? Do you think this will be able to stem or arrest the hit or cushion the economy?
It's certainly welcome, and it's encouraging that the policymakers have moved so swiftly to really try and nip this in the bud, certainly a lot faster than we saw in the global financial crisis in 2008, for instance. But the trouble with fiscal policy, for instance, is that it works with a lag. It hasn't come soon enough to really ward off that first, potentially even that second round of layoffs that we're seeing, and hence the initial jobless claims numbers and payroll numbers over the next month or so will be quite shocking. From a monetary policy perspective, there are still signs that despite the huge amounts of liquidity injections, that liquidity is still tight in some sectors. So there is a transmission mechanism blockage, if you will, and we really need to see some move from the authorities to unblock that. So far, most of the measures have not really addressed the underlying issue of a dollar shortage and also a collateral shortage in the banking system.
All right, Sue, we'll let you go on that one. Thanks so much for joining us on